Hello, good day and welcome to this section. In this class, we're going to be looking at types of currency pair traded in the global financial market. There are three major types of currency pair. These include the major currency pair, the minor currency pair, and the exotic currency pair. We're going to be looking at them one by one so as to explain them properly and understand how each of these currency pair works. Now, the major currency pair. Major currency pair consists of the most frequently traded currencies globally. Because they have massive liquidity, you are able to trade them virtually always. Furthermore, you will find the lowest spread or brokerage cost when trading these pairs. Major currency pair has the US dollar on one side with good reason. The dollar is the world's leading reserve currency and it's involved in about 8% of currency trades. Major currency pairs include Euro USD, USD JPY, Great Britain Pounds USD, USD CHF, CHF stands for Swiss franc, USD Canada dollar, Australia dollar US dollar, New Zealand US dollar. Now what this presupposes is that a major currency has to do with when two strong nations, strong and developed economy comes together. One of those strong and developed economy will be US paired with another strong economy or a major currency. Now, and that is what makes them major. For example, we have Great Britain as a developed nation, we have Australia as a developed nation, we have New Zealand as a developed nation. When any of these pairs with US as another developed nation, so they give the both pair gives rise or give birth to what we call a major currency. In a major currency, US dollar must be one of the currency pair, either the base currency or the counter currency. The position is occupied doesn't matter. What matters is that the US is involved in every major currency. That is what makes it a major, because US is involved plus another developed economy in the world. So that is a major currency. Then we have what we call the minor currency pair. A minor currency pair or cross currency pair, this is when a currency does not include the US dollar. It is when two strong economies pair together with the exception of US. Here are some few minor currency pair. We have the Euro, the Great Britain, the Euro, the Australia dollar, the Great Britain pounds, the Japanese yen, the CHF, which is Swiss franc versus Japanese, the New Zealand JPY, the Great Britain pounds, Canada dollar. Now, if you look at this example outline, you will discover that there is no US dollar in this place. So these two countries, these two nations that are merged together, they are both strong economy. So that means when two strong economy comes together with the exception of US, they give rise to what we call a cross currency or a minor currency. It becomes a cross currency or a minor currency because US dollar is not attached or involved in this pair. The most widely traded minor pair consists of the euro. The euro is a continent comprising of eurozone. We have the yen, which is a major currency in Asia, then all the British pounds. So you can pair any of these with any other strong economy to give you what we call the minor currency. Mind you, the minor currency pair is also called a cross currency pair, and the spread of this currency pair, they are high, though that they are not as high as that of exotic, which we will look at quickly, but they are in some cases higher than the major currency pair. So that is why most people in the global financial market, what they do is that they concentrate their asset on the major currency, and when they have good confirmation, that is when they trade either the minor or cross currency or the exotic currency. So this is a minor currency. When two strong nations combine together with the exception of US, it gives rise to a minor currency or a cross currency. Now we are going to be looking at the next currency pair, which is what we call the exotic currency pair. An exotic pair includes a major currency and the currency of a developing economy, such as Brazil or South Africa. These are developing countries. You would find exotic pair as often as you find major or minor pair. No, which means the spread can be higher when traded there. The spread is actually higher, is very high when trading exotic currency. So for this reason, most traders don't bother to trade this pair because they don't want to pay such a high spread to the broker before they start making their money. So some of the examples of a minor exotic currency pair is the euro versus tra. Tra is what we call the Turkish lira. So that is the unit, that is the symbol of their currency. We call it tra. So the Turkish lira, or the Turkish as an economy, as a nation, they are termed a developing nation. But in Africa, we only have South Africa that is called a developing nation. So we have the US dollar versus Hong Kong dollar. So Hong Kong is also termed a developing nation. We have the JPY versus North Korea, Norwegian krone rather, please. So this is another developing nation. We have the New Zealand dollar versus Singapore dollar. This is another developing nation. Then we have the Great Britain versus ZAR. ZAR is South Africa rand. It's another developing nation. Then we have AUD versus MZA, which is a Mexican peso. All these are examples of exotic currency. The pair, the spread of this currency pair, they are usually high, and as such, traders don't fancy trading this pair. Instead, they concentrate their assets on a major currency or a cross currency. For you to be able to trade an exotic currency pair, you will have at least 88% accuracy of your signal, so that even if you pay high volume of spread to the broker, at the end of the day, you will end up making something out of it. Otherwise, it's not a go area. So the three types of currency pair is the minor currency pair, the major currency pair, and the exotic currency pair. So the currency pair you are to trade is a function of your personality, what you want to make, and how you want to ration your money across various assets. Now remember that you must not trade everything, and remember that most of the assets have higher spread, and you cannot begin to pay much spread, and at the end of the day you make nothing out of it. Instead, as a trader who is trying to master the market, we encourage you to concentrate on the major currency pair, where you pay a little spread of 1.5, 1 or 2, as the case may be, as the highest, to the broker. And at the end of the day, it is always easy to make up those spread, and you also pay a profit at the long run. So the currency pair you are to trade, you should be able to know how each of the currency pair works, how they operate, what drives them, the average volume they will make on a daily basis, so that when you are entering them, you will not make any mistake, but you'll be able to calculate properly and enter them with the right lot size, and at the end of the day you make profit out of it. Now we have types of currency pair: the major currency pair, the minor currency pair or the cross currency pair, and the exotic currency pair. The one you have to trade most should be the major currency pair. The reason being that they have the lowest spread. Aside that, the cross currency also have another lowest spread, though not as low as the major currency. The one that has the highest spread is the exotic currency pair. For you to trade this exotic pair, you must have a strong and a good confirmation, and must be willing to leave your trade to run for some days, so that you'll be able to, after paying the spread, you'll be able to make some profit on top of it. Thank you for listening, and God bless you.